Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are back with our resident gold expert, Jordan Roy-Byrne. Jordan, thanks for coming back on the show.
Hey, Steve. Thanks for having me back. It's a real pleasure.
Yes, sir. Yes, sir. Okay, let's start out like we always do. What's your macro view of the gold and silver market right now?
Yeah, I think it's difficult because if you're looking at the stock market up until a couple months ago, it looked like the stock market was setting up for a real significant bear market. I call it a mega bear market where there's been 6 in the last 100 years. And in the last month or so, the stock market has rallied a bit too much and it's been a bit too strong if you look at the internals for it to continue down that path. So it's on a different path. And what really complicates that is we haven't had a recession yet. We haven't, and at the same time, we haven't felt the impact of all the Fed tightening because there's a delayed impact.
Yeah.
And it's really tricky because if a recession were imminent, which it kind of feels like, the market would not be performing as well as it has been, especially in the last couple of months. However, what makes it tricky is I do think we're going to get, I would bet on at least a mild or a moderate recession. And when that occurs, maybe that's not going to occur until middle of the year, maybe summer or late summer, possibly. And then at that point, the market could roll over again. But there's really not, because I always like to look for historical comparables. There's really not that great of a historical comparable where the market had this big move down and then had this really strong rally right before a recession started. So the way the market is acting is it's basically discounting it's discounting that we're going to have a mild recession and potentially a soft landing. Now, I mention all that because that's very important to gold and precious metals, because if that's the case, then you're not going to see that much long-term upside in precious metals. You could see at some point, we probably are going to get a recession and the Fed will have to cut rates a little bit. And I think that would be enough to get gold to 23, 2,400, silver, back to 30, maybe a little bit higher. But in that scenario where you actually can have some kind of recovery, in the general economy, and the Fed doesn't have to cut rates down to, 2 or 3%, for example, that's going to be tough for gold. So the macro picture is really, to me, it's always uncertain, but it's especially uncertain right now because, again, the market's acting like we're going to have a soft landing. And, if it looked like we were going to have a really hard landing, which is still possible, then I would say, okay, the coast is really clear for precious metals, like over the next several years and not just over the next 12 or 18 months. But even in a soft landing scenario, I think the Fed will they'll have to ease policy at some point, and that should give gold and silver a jolt to the upside. But I think beyond that, it's questionable at this point.
Yeah, I was talking with someone about this. I can't remember who, and that we're going over black swans, and one that is my Daniel, my buddy, and one of them was, well, maybe the black swan is the Fed actually creates a soft landing. Like maybe that is possible. I don't know.
Yeah, the interesting thing is, and if you look at history, I see a lot of comparison. We've been thinking in the last couple of years, this is a repeat of the 70s, but based on all the data I'm looking at, this really looks like the 1960s, somewhere in the 1960s, because it's true that the secular bull market in stocks didn't really end until the end of 68. However, from the end of 1961 and that stock market peak in the S&P over the next 7 years until the end of 68, the S&P gained only 50% over 7 years. So that's for the end of a bull market, like that's not really that impressive. And, in the mid 60s, like gold stocks really inflation took off, and, gold stocks were really one of the only things you could buy, gold stocks and energy stocks, basically outside of just, conventional businesses. There weren't tips, there wasn't foreign currencies. You couldn't even buy gold. I mean, I guess you could buy silver, but based on the data, it looks to me like it didn't really trade that much. So, I mean, even if there is a soft landing and, the stock market's able to, trudge higher, you could say, even in that scenario, I don't see like a real Goldilocks situation, just because if you look at all these indicators, if you look at valuations, if you look at expected returns, they're showing that the market is not, it's only going to get at best 2 or 3 or 4% a year over the next 10 years. And when you add it up and think of where the S&P can be in 10 years, I mean, I'm looking at some of these numbers and it's in the low 5,000s, which is really not that impressive considering it was just at 4,800, 13 months ago.
Yeah.
And that it's at, whatever it's at now, 4,000 or 4,200. I mean, that's not 25 or 30% over 10 years, is really not good. But that's basically what happened in the 1960s. And so that's the comparison. I mean, the inflation really wrecking the economy and really hurting the stock market. I mean, I think that's all ahead of us. We are going to have a 1970s repeat, but here and now we could be. I mean, 1966 is a real interesting point because we had a soft landing, and the Fed cut rates, and it wasn't that. It was only like a 2 year. I think the market only went up 50% from the low in 66 to the peak in 68. So we did have a soft landing. We avoided recession at that point. It was an inflationary time, but the next, the cyclical bull market after that, it didn't last that long. It wasn't impressive. So even if the Fed engineers a soft landing, it's not like we're in 2016 or, 20, the mid 90s or the mid 80s where they engineer the soft landing and the economy can run for 4 or 5 years. I mean, that's just not, given everything that's happening. I would see something more like the mid 60s where it only ran for 2 years. So I don't mean to like be unequivocal about things, but that's where we are. It's always complicated trying to assess where things are going, but that's kind of where we are. We're veering off into territory where there aren't that many great comparisons, but that's just kind of what I'm thinking as far as what we can see. Gun to my head, I'd probably say that, yeah, we're looking like the mid 60s right now.
Okay, that's interesting. Yeah, everyone's comparing it to the 70s, so it's kind of nice to hear something different. Okay, so gold has had we hit that triple bottom of like, I think it was 1615 or 1611. I couldn't quite tell exactly what it was, but we hit that triple bottom a little while ago. And then since then, it's just kind of been going up. And for the last, I don't know, month or so, I've been thinking like, man, we really need to see a correction in gold. And I've just been wrong like every single week. And it just kind of kept just going up. We got the rate hike from the Fed yesterday. We're recording on Thursday the 2nd. And it shot up. And then today it shot down about 2%. Do you think we've kind of started to roll over a bit here and maybe now we'll start to get a correction? What do you see short term coming up for gold?
Yeah, it's definitely possible. I mean, 1950 to 1960, there's really stiff overhead resistance in that area. And I guess today we got as high as 1975 before, a big reversal. So looking at the chart, there's a really ugly daily candle after today. And looking at the weekly chart, I would say, I mean, it is possible that we hit the peak for this rebound, although I mentioned there was a potential inverse head and shoulders bottom. I wouldn't say it fit the parameters perfectly, but it was a legitimate setup that projects to a target of 2020. So I would love to see gold continue on to that point, but I'd have to err on the side of saying, we probably saw a top today. That would be my guess. I mean, even if gold did not top today and it were to move higher, I'd say, yeah, 2020 would probably be, or 2000 would probably be where it would stop. So in either scenario, we're looking at probably lower prices, or at least the path of least resistance could be lower in the next month or two. And that's also going to depend on the stock market. If the stock market runs for another, let's say, 2 months here, that's going to take some money out of gold. And, fundamentally, that's not great for gold, because if the stock market's able to run for a couple months, maybe that reflects that the economy, the odds of a soft landing might get even higher at that point. And so that would be temporarily negative for gold. But generally, that's my view over the next couple months. I think we're going to see lower prices, but it's going to be really interesting to see. And of course, there's guys like me and everybody out there, they're looking at charts trying to pick a bottom. But for me, I continue to focus on the stock market, because the stock market is going to be a reflection of the economy, but even more so the bond market. I mean, that's really important. Because the Fed follows the bond market. If we see bond yields really come down in the next month or two, that to me would be an indication that the economy is probably in worse shape, and that you would probably see gold really well bid on the downside.
Yeah.
So I'm looking at, 1830, 1835 is a really significant support level. Also, I'd say 1795, right there around 1800. So to me, those are the key downside levels I'm looking at. But again, I'm more concerned about what's happening in the bond market and, what's happening in the stock market and the economy. I mean, some of this economic data, if it continues to get worse over the next couple months, then that's going to, you'll see interest rates in the bond market come down. And again, that's the macro driver for gold. That's very positive for gold. So that's what I'll be watching.
Okay. What, speaking of the market, S&P, I think, is around 42. Where do you see that kind of next level of, do you see it going as high as like 44? You know how it was kind of coming down into that, triangle pattern that was going to resolve itself in, I think it was February 17th, and we blew above that, and now we've kind of created a new level. So, it was showing that it was going to go up rather than down. Where do you see the S&P kind of topping out? Or yeah, I've also heard arguments for a blow off top too. There's guys like David Hunter that have been talking about this for a while, but how do you see that one playing out?
Yeah, looking at the chart, there's really stiff resistance around 4,300. So, and I've heard some people talking about 43, 4,400. So I would lean into that. I would lean towards that camp, I should say. Just laterally, 4,300 looks like stiff resistance. It's possible the market could pop above it for a little while, but I'd say 4,300, maybe 4,350,
Okay.
maybe even 4,400, but we should have some more legs here in the stock market in the short term.
Okay. Okay. And silver's been kind of just grinding sideways, between 23, 24 bucks for, it seems like 6 weeks now. I feel like it's just a spring that is coiling up and is ready to go one way or the other. You say that gold moves first and silver follows. I wonder, we've kind of had this just rapid rise in gold recently, with silver grinding sideways like this, just building up pressure. If gold is likely to correct and come back down, do you think silver is likely to do that too? Or is there some pent up energy you think that maybe now it's silver's turn to run a little bit?
It's really interesting because, yeah, gold normally leads, but at the bottom, silver actually bottomed first, even before the miners in gold. And so you don't always see that. And it was leading to the upside. But unfortunately, gold, in the time where gold's rallied over $100 an ounce. Silver has done nothing. So this rally in silver was basically, looking at it, I mean, this was pretty much done with in early December. So almost, I mean, just I'm looking at the weekly chart. I mean, in the last 1, 2, 3, 4, it's like done nothing in the last 7 weeks. So that to me is disappointing considering the big move in gold over that time. So I think I mean the macro always determines whether silver's leading gold or gold's leading silver, outperforming or underperforming. But I think the path of least resistance for silver is probably lower. If I'm right about gold making a short-term peak here or pretty soon, I think it's very unlikely we're going to see silver strong in the next couple months. I think it's probably going to trade lower. And for silver to make a really big move, I think we're going to need to see gold probably make a new all-time high, getting above that 2050 or 2100 resistance, because silver has really stiff resistance in the 27, 28 area. And there's even some monthly resistance at 25, which is what stopped this move. So it's kind of disappointing. If we were talking here 6 or 7 weeks ago and we were to know for a fact that gold was going to rally another plus $100 an ounce, we would have thought, oh, well, silver's definitely going to get to at least 26 on this move, probably 27, 28. But that never happened. So it's disappointing. So yeah, I think the path of least resistance for silver, at least in the next couple months, is lower.
Okay. How do you see gold in 2023 as far as, do you think we'll hit that all-time high like we did last year?
Yeah, I think we will. I mean, it's rallied significantly off the low, and I would have thought that this is going to peter out in the low. I'm looking at the 20-month moving average at 1815 now, and 1835 is a really significant level. That's what I would have thought, that it would probably peter out in the low 1800s. So it's been very surprising. It had a monthly close. I believe it was above 1950 or pretty close to that a couple days ago. But I think not just based on the chart move, but also the macro. Even though I think the macro over the next month or two is not looking bullish for precious metals, I do think the odds of at least a moderate recession, I think, are pretty high at some point this year. And when the Fed is done hiking, of course, everybody's saying, or most people are saying, they're going to hold rates there for 12 or 18 months and blah, blah, blah. But that they follow the market. And if bond yields turn lower, they're going to follow the market, and they'll have to cut rates at some point this year. So, those macro data points, if I'm right about that, then I think gold is likely to break out this year and go above 2100.
Okay. Yeah, I was looking out at, I call it the Vegas odds, but I was basically looking out at the odds of what the Fed rates are going to be going out. And for March 22nd meeting, they've got 84.1%, another 25 basis points. Then the May meeting, the highest percentage chance is that's when the pause starts. I'm sorry, that's when another 25 basis points goes. Then the following meetings, the highest percentage chance is that they're pausing until the November meeting, which is when the market thinks that they're going to start cutting. So at least as far as the market thinks right now, it thinks that another 25, then pausing until November and cutting at that November meeting. But who knows? We'll see. I thought they would have paused last year, so I was very wrong.
Well, me too. I thought they were going to stop hiking last summer or last August or September. So I've been wrong about that. But nevertheless, the precious metals have acted. They have acted as if the Fed was stopping when we thought they were going to stop. That's the interesting the interesting point, is that we were completely wrong about this, how much the Fed was able to hike. But nevertheless, if you were thinking a year ago, okay, they're going to be able to hike they're going to be able to hike some, when are precious metals going to bottom? You would have guessed right about the bottom, but not about the hiking part. So that's what's interesting to me. But and these things can really shift quickly. If you see the bond market, which I've seen some sentiment indicators where the crowd and the retail investor, they're really bared up on bonds right now. So I think if the negative economic data just continues for another month or two, that could pressure bonds higher, which means yields lower. And if you get a real accelerated move down in yields, I mean, the market is going to start pricing in cuts. I mean, they'll do a 180, because this is what happens every cycle. The Fed, whenever the Fed's doing the last hike, they always project. I mean, the first cut is always way off into the future, and they say, "Oh, we're going to keep hiking a couple more times," and then suddenly, like a month later, they indicate they're pausing, and then the market starts sniffing out the cut, and then when they indicate they're going to cut, the market really prices it in. So it's important to follow those expectations. But my point is, follow the bond market, because if it looks like we're going to have even a moderate recession, if that's going to hit mid-year, we're going to see rate cuts probably before the end of the summer in that scenario.
Okay. Interesting. All right, cool. Well, thank you, Jordan. I appreciate it. So guys can follow you at thedailygold.com. If betting on gold interests you, specifically junior gold miners and junior silver miners, I got to tell you, man, this is a lot of fun, because you think gold going up or down $100 an ounce is exciting. Wait till you have a junior miner on that. That makes it very, very leveraged. So thank you, Jordan. I appreciate you coming on the show.
Oh, my pleasure. Thanks so much for having me.